Hi, everyone. Well, fair warning, this week's update is going to be a little wonkier than usual. But stick with me because what's happening in the bond market right now has some pretty important implications for investors. This week, I want to spend a few minutes talking about something that's been getting a lot more attention lately, and that's the move higher in long-term interest rates. The 10-year Treasury yield is around 4.7%, and the yields on the 30-year have moved to levels we haven't seen in decades. In fact, last week, the Treasury sold $25 billion of 30-year bonds at a yield of 5.216%. That's the highest yield for that type of auction since 2021. So what's driving this? I think there are three things that are really worth paying attention to here. The first is simply a lot more competition for capital. And we've talked quite a bit about the massive amount of spending taking place around artificial intelligence. The biggest technology companies are spending enormous amounts of money building data centers and the infrastructure necessary to support AI. And increasingly, they're tapping the bond market to help fund that build out. Investment grade companies have issued nearly $1.5 trillion worth of bonds this year, which is up about 36% from a year ago. And roughly 20% of that issuance has come from AI related companies. When you look at the biggest technology companies specifically, their borrowing is equivalent to roughly 25% of the Treasury's net issuance to private investors. And that's a pretty remarkable number. And the scale of that spending is also pretty remarkable. Capital expenditures at Amazon, Meta, Microsoft, and Alphabet have accelerated dramatically and are expected to continue climbing while their free cash flow hasn't kept pace. And this helps explain why these companies are increasingly turning to the debt markets to finance some of that investment. And there's only so much money to go around. If the Treasury needs to borrow enormous amounts of money, and at the same time, some of the largest companies in the world are also issuing enormous amounts of debt, someone has to buy all those bonds. More supply without a commensurate increase in demand generally means investors are going to demand a higher yield. The second issue is our fiscal situation here in the United States. The federal government continues to run annual deficits in excess of $2 trillion. That means more borrowing, more Treasury issuance, and again, more supply that investors have to absorb. And then the third piece is something we probably don't talk about as much, which is really what's happening with interest rates outside of the United States. For a long time, U.S. Treasuries were one of the few places around the world where investors could earn much of anything on high-quality government debt. Think back to 2020. At one point, there was more than $18 trillion of negative yielding debt around the world. And negative yielding debt literally meant investors were effectively paying governments for the privilege of lending them money. That environment is long gone. Today, yields are rising in a number of major economies as they deal with their own inflation and fiscal challenges. Japan is particularly important. Japanese government bonds, or JGBs, are now yielding more than they have in roughly 30 years. Japan matters here because they've historically been a very reliable buyer of U.S. Treasuries. In fact, Japan is the largest foreign holder of Treasuries with more than $1.1 trillion total. So if Japanese investors can suddenly earn more attractive yields at home, that potentially reduces an important source of demand for U.S. government debt. And that matters because global investors now have alternatives. If you're a Japanese investor, for example, you no longer necessarily have to come to the United States and take currency risk just to earn a reasonable yield. So you put all three of these things together, massive corporate borrowing related to AI, continued U.S. government deficits, and increasingly attractive yields overseas, and you can understand why there's been upward pressure on longer-term Treasury yields. And when you take a longer-term view, the change is pretty dramatic. Both the 10-year and the 30-year Treasury yields have moved substantially higher from the extraordinarily low levels we saw around 2020. But what does all this mean for investors? There are a few implications. The most immediate is higher borrowing costs. So the average 30-year mortgage rate has moved up to around 6.7% in the United States, its highest level in about a year. Higher yields also raise the cost of capital for corporations, particularly those companies that are making large capital investments and relying on debt rather than free cash flow to finance them. And then there's one other implication that I think becomes increasingly important if yields remain elevated. At some point, bonds will start becoming real competition for stocks. If investors can lock in yields of, say, 5%, 6%, or even more in certain parts of the bond market, while taking a fraction of the risk or volatility they would experience in equities, that becomes a pretty compelling alternative. I don't think we're necessarily at the point where that causes investors to abandon stocks, but the higher yields go, the higher the hurdle becomes for equities. And I think that reinforces something that we talk about all the time. It's the importance of diversification. For much of the last decade, bonds offered very little income. And today, investors have more options. And having meaningful exposure to both bonds and stocks gives us the ability to participate in long-term equity growth while also taking advantage of much more attractive yields in fixed income. That's something we'll continue to watch closely, especially if longer-term rates continue climbing higher. I'll leave it there for right now. Have a great week, everyone. I'll see you soon.